What's up YouTube? Welcome back to the channel. In today's video, we're going over Bird's Q4 and full year 2025 earnings. This was posted on March 12th after market close. Starting off, financial highlights. Strong cash generation with further margin expansion. Full year revenue in line year over year. So they didn't grow revenue. It was pretty much in line with last year's revenue, but we'll get into why later in the video. Their backlog was up 44% year over year. And adjusted EBITDA margins up 4.4% year over year. And then adjusted earnings down 3.2% year over year. We'll also get into that later in the video. So for on this slide, record $11 billion in combined backlog for the next 2 years. This includes securements across our business units with growth in line or above market growth, successive work packages on large capital investment projects despite client-driven delays in 2025, and robust reoccurring revenue streams. So over the past 4 years, they've seen 24% compounded annual growth of their backlog, and 54% of this backlog is expected to be recognized over the next 12 months. $6 billion in revenue over this next year they're expected to see, and they secured $4.7 billion for the full year 2025. So next slide, sustained adjusted EBITDA progression, margin expansion driven by infrastructure growth, supported by higher margin contributions from Jacob Bros and FRPD, their newly acquired company, and a continued shift towards accretive sectors. This also includes their cross-selling between their different companies, so like Jacob Bros, FRPD, and then Bird itself. They're cross-selling in between different work, creating higher EBITDA progression. And then this is just a slide for their different projects. I won't get into that too much. So growing addressable markets with near-term tailwinds. So they see $89 billion in industrial, $89 in buildings, and $97 in $97 billion in infrastructure. And then diversified sector positioning, $9 billion in nuclear, $10 billion in industrial maintenance, defense $13 billion, data centers $15 billion, healthcare $10 billion, and transport, trade, and rail $59 billion. What kind of really interests me is nuclear and data centers. So their capabilities and solutions, comprehensive nuclear expertise, combined certified quality systems, collaborative delivery, and then record activity in sector with approximately 10% of revenue and growing. And then for data centers, integrated self-perform, multidisciplinary platform delivering complex power solutions, underpinned by deep transferable expertise and disciplined execution on safety, quality, and schedule. So with technology advancing so much and these data centers becoming so prevalent with the AI growth over these past few years, I do see that this is a good opportunity for Bird to help build with clients. I'll also get into that a bit later with their earnings call because there was some narrative on that as well. But I find nuclear and data centers go hand in hand because data centers are so energy demanding, and also with the world wanting to go towards clean energy, nuclear I find it very good that Bird is expanding their nuclear portfolio, which also in the earnings call they get into. So this slide is their new acquisition of FRPD. So accelerating infrastructure growth with FRPD, their newly acquired company. So expands Bird's self-perform capabilities and enables greater scope participation, unlocking national multi-year infrastructure growth opportunities. So FRPD operates mostly in marine and infrastructure, so it deepens Bird's infrastructure self-perform offering with marine construction, dredging, underwater excavation, and land foundations. Strengthens their infrastructure mix and execution depth, expands Bird's national infrastructure presence, and unlocks cross-selling and broader participation across Canada, creates cross-selling opportunities with Jacob Bros, industrial, and across Bird's platform. So next we have this slide, strategic progression towards a balanced sector mix. So by 2027, they plan on having 26% in infrastructure, 37% in buildings, and 37% in industrial. So this will give a more diversified approach to their revenue streams. And then this slide I found kind of interesting. They're actually incorporating AI into their process. So predictive analytics to enhance efficiency, reduce risk, and support data-driven decision-making on complex projects. So this predictive analytics will help their strategic tools combining data, machine learning, and advanced automation, support internal operators, and external opportunities, risk management. This will also help forecast risk, anticipate costs, and identify safety and quality issues before they arise. This whole AI model is helping anticipate risks and protecting margin, turning proprietary data into foresight, allowing for enhanced visibility to potential outcomes earlier in the project cycle. So this helps better gauge their projects with their clients. They can give their clients a better explanation as to why things might be going the way they are. If it's delayed or going ahead of schedule, they can use these analytics to communicate with their customers better, which I think is pretty cool that they're doing that. And then path to 2027, risk balance model with a proven track record of generating growth and profitability. So by 2027, they're projecting 10% revenue growth plus or minus 2% will be driven by historic combined backlog and structural tailwinds. So a lot of this backlog that they've been acquiring over the past year during these rocky times in the economy, it's finally going to start acting as a tailwind to their company with a low spot of 8% EBITDA margin, upwards of 12%. So finally we get to their Q4 and full year 2025 financial highlights. So revenue, $877 million, a loss of 6.4% year over year. Gross profit, 97.41%. An adjusted EBITDA loss of around 8% year over year. And then net income, a $14 million loss, which a loss of 25 cents earnings per share, or around 142% loss year over year. This I'll get into later on the earnings call. This was caused by a impairment on one of their contracts, and then adjusted earnings down 14.6%. Again, it impacted by the impairment. So I'll get into that later on the earnings call where they have kind of the narrative surrounding why this was the case. And then full year flat, $3.3 billion. Gross profit up 8.6% year over year. Adjusted EBITDA up 4.4% year over year. Earnings per share full year change down 52%, and adjusted earnings down 3.2%. Cash flows from operating activities down 1% year over year. So next for this cash flow slide, cash flows from operating activities saw a 33% compound annual growth rate over the past 4 years. Although cash flow was down 1 million compared to 2024. 33% over the past 4 years is a substantial growth rate. And then free cash flow also did see a decline from 2024 down to 72 million from 80 million. But their free cash flow generation here, 151% conversion on net income and $1.3 per share, free cash flow per share. And then their adjusted return on equity, 25%. So that's really good. And then lastly, their 2026 guidance. So record combined backlog of contracted and awarded work exceeded $11 billion, providing good visibility to expected revenues for 2026 and into 2027. They're continuing to secure new awards at a pace that exceeds execution, supported by a robust bidding environment across industrial, buildings, and infrastructure. So they're still seeing good demand for the environments for their new contract bids across all three of their sectors. And then strong balance sheet and liquidity supported by solid operational cash flow generation, enabling execution of record backlog and flexibility for strategic tuck-in acquisitions that broaden Bird's capabilities across Canada and key sectors. And with that, we will go to their earnings call because I found there's a lot of useful information on this whole report in the earnings call. So we'll hop over to that now. So I won't go over their whole earnings call, but I did highlight some things I thought were kind of important. So The CEO says looking ahead, approximately 54% of our backlog is expected to be recognized over the next 12 months. This is further supported by record backlog of $1.5 billion of reoccurring revenue, and this is further supported by record $1.5 billion of reoccurring revenue contracts, with industrial maintenance and other reoccurring revenue expected to contribute over $500 million per year. Along with the continued conversion of pending backlog, Bird's record combined backlog with a strong embedded margins than a year ago demonstrates the underlying momentum of the business and supports our confidence in Bird's long-term trajectory. We do not see the opportunity set slowing down, and as major projects advance, we expect the volume of opportunities to increase. Even though they're getting all this record backlog, they still see demand going into the future, which is really good to see. Then there's a significant depth across Bird's end markets with near-term tailwinds supporting demand across energy, defense, healthcare, data centers, transportation, and trade infrastructure. With all this backlog and demand, now they're starting to see tailwinds pushing the business forward after the past year has been kind of rocky and uncertain with the economy. And then they also have some narrative about their defense portfolio continues to accelerate. With the Department of Defense's plan, $100 billion in construction revenue over the next 10 years, which includes $40 billion in the north over 20 years. This is in reference to their Arctic projects. And then for data centers, they're currently tracking more than $20 billion in data center opportunities and see momentum continued to build through 2026. Now for the CFO says, as anticipated, construction revenue in the fourth quarter was $877 million, lower year over year, reflecting the timing related to project delays. So, as previously said, a lot of these projects have been delayed, seeing revenue down or just uncertain in the near term. And then more negative stuff here. Net loss in the quarter was $14 million or 25 cents per share compared to net income of $32 million or 59 cents per share in the fourth quarter of 2024. This decline reflects the $62.2 million impairments on accounts receivable and contract assets related to creditworthiness concerns for a single customer that was previously disclosed. The sole project is substantially complete and no further costs are expected. So despite having this huge hindrance on their earnings, this was a one-time thing. It shouldn't affect their business going into the future. And then down here, revenue of all companies' businesses in 2025 was impacted by delays in the start of contracted projects resulting from economic uncertainty. Despite flat revenue, profitability continued to improve. So on the positive note, they're still increasing margins and they're becoming more profitable with the revenue they did have throughout the year, which will help them going into 2026 as well as 2027 when they are able to capitalize on all this big backlog that they have. Then he states, our priorities are clear and unchanged. We continue to invest in our businesses through capital expenditures and equipment and technology to support execution. We remain active and disciplined in mergers and acquisitions, pursuing tuck-in acquisitions that enhance our capabilities, expand our footprint in key markets, and are accretive to margins and cash flow. And then lastly, before the Q&A section, he says, bidding environment remains highly active across defense, nuclear, data centers, healthcare, trade, and transportation, with risk-balanced record backlog of more than $11 billion with average margins higher than a year ago. Bird has strong visibility through 2027 and clear momentum towards its strategic plan growth and profitability targets. This is supported by a strong balance sheet, disciplined capital allocation, and ample liquidity. Bird is well positioned to execute its record backlog, invest in growth, and continue delivering shareholder value. So now for the Q&A. The CFO states that the Q1 is still going to be a little bit muted. They're not going to quite see revenue and projects really start ramp up towards the later half of Q2 of this year. So Q1 might still be a bit flat, I'm thinking, but in the second half of 2026, he says, I think we're going to see very robust growth. So towards the second half of this year, they'll really start to see things ramping up. And he says, we have record backlog. We've got more visibility into the 2 years out than we've ever had before. So despite the near-term kind of weakness over the past year and going into Q1, towards the second half of the year and going into 2027, they will start to see a lot of this this backlog finally be realized. And then for that impairment I was talking about earlier, he says, we took a full impairment in Q4 for the $62 million made up of accounts receivable and contract assets, so we're not carrying a recovery on the books at this time. We are going to pursue a recovery, but we decided to take a pretty conservative view of it. Certainly nothing is going to be imminent on any potential future recovery, and we're just going to follow the normal course there. Just with how the facts are playing out in this particular instance, it's not something that we can really go into a lot of detail at this point in time. But I guess the key point here is just know that we're going to pursue a recovery, but it may take some time before we see any of that. So despite taking that $62 million hit, they are going to eventually seek recovery. Again, he didn't say when that will happen, but it would be nice to see that come back eventually. And then for the nuclear part, I wanted to talk about, they've got large program underway with Ontario Power Generation. We're building 5 facilities for OPG right now at the Pickering nuclear facility. We've got some work that's evolving in some of these other nuclear facilities in the country. Decommissioning is still at a very high pace, some new opportunities that we're in procurement on for that. So I'd say it's certainly a robust area. I can speak to it more in terms of overall percentage of revenue because of the MSA aspect of it. So we'll run it around probably 10% of our revenue, with anticipated growth in 2026 in nuclear-related activity. And they're saying we're building essentially a weapons-grade uranium testing facility that is the same nuclear-grade concrete and things that you'd like to have on an SMR or large-scale nuclear program. So the resume we're developing is quite strong, and now we have the required certifications and licenses to essentially do an end-to-end nuclear. So building out this resume, they'll eventually get more and more contracts for nuclear, which I like to see, given the energy demand of this state of the world right now. And then again down here he just says that they're focused on resume development right now, but eventually they'll be doing some large scale hydroelectric projects underway with OPG, and that's going well, and those will all enhance the scale question about our capability to handle those large scale nuclear projects. And then for the narrative around data centers, the CEO says we've historically had experience here in smaller data centers in the province, like small, predominantly on the electrical side. But he says it feels like we're just at the tipping point here on a large scale. There's some large scale ones that are in procurement right now. It'll take a lot of capacity, to be honest. The secret web for us is a large electrical army that we have a number of those resources here in Alberta. Alberta has like 40 individual companies that are in discussions with the government. So he says there's potentially 40 different projects. They all won't get built, but they need to have the power, and government sort of mantra here is we've got the gas, bring your own power, and we'll work closely with you to develop these. So it seems that if these companies can find the energy, which in Alberta should not be an issue, they will be able to keep rolling the ball with these new AI data center projects. Then he says down here, we have a pretty good sense of where everyone is and where they've all been evolving. And the major markets for us now would be Alberta and Ontario, but they also have projects underway right now in Manitoba, and then emerging opportunities in Saskatchewan and Atlantic Canada. So he says it feels like we're just getting towards the tipping point after a few years of a lot of planning. So within the next few years, we could really see a lot of these projects start to develop. And with the AI race going on right now, it'd be pretty huge if Bird can tap into a lot of these data center productions. It would really help out their different revenue streams, in my opinion. And then lastly, in this earnings call, I just want to quickly go over their use of AI. So it says predictive analytics is something that we've been working on now for 18 months, and we're able to evaluate projects. It's a very powerful tool in the sense that I've been in construction my whole career, and you do develop an eye for productivity or an eye for progress on a project. So they're able to generate predictive flags at a very early level, sometimes 10 or 15%, which you normally would be catching up to until you're sort of midway through the project, maybe 50%. So they're able to kind of predict the project and costs way before the actual midpoint. So this can help better gauge with the clients, which he also does say down here. So we're able to share that predictive ability with the clients. If you're working collaboratively with the clients and the types of contracts we have today, they want to be fully aware of anything that's giving them any concern around schedule and anything they can do to enable, whether it's moving utility or the utility relocation gets delayed, what the impact is on the project. So with all these tools, it can be very powerful in this field, he says. So I find this pretty interesting that they're incorporating this all into their business, because this will help them on the analytics side and just productivity side. I think this is a pretty smart idea. So I thought that was kind of neat that they're starting to do that. So far this year, bird construction is up 19.5% or $5.56. They are seeing a lot of positive momentum in the stock price. Going into this earnings, I wasn't really expecting a whole lot. I knew they were having a lot of headwinds over this past year, so it was kind of a pleasant surprise that it wasn't worse, I'd say. And it wasn't a good quarter, it wasn't a bad quarter, it was just kind of another meh quarter. But a lot of the narratives throughout this year are gonna start acting as a tailwind. Like they're still acquiring a lot of backlog that we'll start to see recognized in the next year and into 2027. With the stock price up where it is right now at all-time highs, I don't think I'll be buying more at this time. I may wait for another dip down into the mid to low 20s range before I pick up more shares, but personally right now I'm not adding more. I'm just holding. I do have strong conviction in long term that Bird will do good, especially if they're able to increase the revenues over the next 2 years, like they say they're going to. So, but yeah, overall, Mac quarter, um, full year was all right. Their revenues were in line with last year, so no real decline that sense. You're like on a year basis, but over this quarter, that impairment kind of really hindered them. Yeah, I won't be buying more, but I will be holding. I'm really excited to see how this next couple years goes. So with that being said, thanks everyone so much for watching. If you like this kind of content, please like and subscribe, and I'll see you in the next one.